Hello everyone, this is Team 8's presentation on profit sharing.
I'm Colt. I'm Gavin.
And I am Brent, and we are going to tell you why the employees will be saying, show me the money. So what is profit sharing? According to our textbook, profit sharing is an organization-wide incentive program in which employees receive a bonus that is normally based on some percentage of a company's profits beyond some minimal level. It depends on profitability. Profit sharing depends on how much the company makes, and a portion of that will then go to the employees. It will actually, why we should do profit sharing is actually leads up to higher productivity. However, if the company does not make any profit, that's no problem because we don't have to contribute to that. So why profit sharing? Profit sharing helps attract and keep talented employees. It will also benefit both the regular employees and the owners and managers because both people will earn a portion of the company's profits. It also allows flexibility for employees because once they leave the company, they can still take that money with them or transfer that account. And it also allows for financial security in retirement. As seen in this graph, profit sharing increases earnings as well as growth in the long term.
As you can see from this graph that we got from one of our sources, profit sharing with teams has the most increase in productivity, when profit sharing with no teams has a steady gradual increase in productivity. But when companies don't have a profit sharing plan and they have teams, it leads to a drastic decrease in productivity. And when a company does not have profit sharing and they have no teams, it leads to a gradual decrease in productivity. Some benefits of a profit-sharing plan are that it leads to higher productivity and profitability, not only for the company, but for the employees as well. The employees are going to feel more motivated and want to work harder, knowing that they're going to get to see a part of the profit that the company is actually making. Like any other retirement plan, like a 401k or Roth IRA, if you take the compensation out before you're 59 and a half, you're subject to a 10% penalty. So if you take $100 out, you're subject to have 10% of that taken, which would leave you with $90. Another benefit of profit sharing is that no matter where you go, employees will be able to take it with them when they leave the company. So if you're unhappy, but you really like the profit sharing plan that your company offers, you'll be allowed to go to another company and take that plan along with you. Lastly, workers are more likely to intervene with loafers and people that putz around due to the fact that everyone is going to have to be held accountable and everyone's going to have to put in their fair share of work. Some drawbacks of a profit-sharing plan is the free rider problem. This is when workers received incentive even though they didn't put in as much time and effort as everyone else. People like this are also called shirkers and a loafer. This is normally due to the fact that they don't do much and they kind of just loaf and putz around while everyone else does all the work.
In order for a profit-sharing plan to be installed properly, a few things need to happen. First, top leadership in an organization needs to adopt a written plan document. This will serve as the foundation of day-to-day operations, and many leaders hire financial institutions or retirement professionals for this. This document even has the structure of how year-to-year contributions will be made. Profit sharing can be available to those companies of any size, even with other established retirement plans in place already, such as a 401k. There needs to be, in the written plan document, a formula set to determine how contributions are allocated to participants' accounts. According to the business strategy and corporate culture, this could vary greatly. So it's in the top leadership's discretion how they want to do that. The plan's assets have to be held in a trust fund or a trust. This assures that the assets are solely used for the benefit of the participants. A trustee should be used to handle these contributions, investments, and distributions. Hiring the right trustee of the fund is probably one of the most important things you do when setting up a profit-sharing plan. Also, an accurate record-keeping system properly tracks contributions, earnings and losses, and investments, expenses, and other distributions. Usually, with the use of outside financial institutions, they already have effective record-keeping systems, so you probably won't have to worry about that. It will aid in preparing Also, the plan's annual report for the federal government. Finally, you have to notify the employees who are eligible to participate about the benefits, the rights, and the features of the plan. In addition, a summary plan description, also called an SPD, must be given to all participants of the plan. This is the main avenue in which information about the plan will flow to participants. Usually, the summary plan description, SPD, is created in the plan document. Operating a profit-sharing plan can be quite tricky and complicated, but if you have an understanding for the basics, you can have a successful plan. Let's talk about participation. Who can participate? The answer to that is all employees. Rank and file, managers, owners, executives, anyone can participate. Usually, this plan does exclude those, however, that are under the age of 21, those that have contributed 1 year of service to the company or less. Some plans have 2 years or less. And of course, non-resident aliens. As far as non-discrimination goes, annual tests are usually done to make sure that the amount or proportion of compensation given to the plan is proportional amongst rank and file employees and owners and managers. Uniform percentage for all participants, such as 10% for all employees, both rank and file, owner, manager, for everyone, is a great non-discriminatory practice. As far as contributions go, as said before, top leaders decide how much the business will contribute to the participants' accounts in the plan. However, the limits that any plan, profit-sharing plan that is less than 100% of the participants' compensation, or as of the year 2021, no more than $58,000 per participant. If the employer makes contributions to the plan themselves, they can deduct 25% of the compensation paid during the taxable year to all participants. When investing is concerned, contributions can be fully vested when made, or they can vest over time according to a vesting schedule. For the record, fully vested means non-forfeitable. The employee has the right and ownership to the compensation. Lastly, there's responsibilities. Many actions needed to operate a profit-sharing plan involve fiduciary decisions. Controlling the assets of the plan makes the business entity for hire, such as the financial institution that was used, and the owner themselves, or top leaders themselves, fiduciaries. It makes them fiduciaries. A fiduciary is one who holds a legal or ethical relationship of trust with other parties. When these people are involved, they are fiduciaries, which means it is up to all fiduciaries to act in good faith, with confidence, reliance, and trust, and benefit towards the beneficiaries. Monitoring the services provided by the financial institution, if one is used, and documenting the selection process is important in relation to determining if changes are needed. So, who should you select? Well, a plan service provider has affiliations, financial conditions, experience or no experience with profit-sharing plans before they have assets under their control. This is all very useful data, and you should find out about this data. It could be the key that unlocks your plan's door or shuts it, and it will send you in the right direction and your choice. Some transactions are illegal, so let's talk about the protection that policyholders have. These transactions are made illegal to help combat certain connections to the plan, self-dealing, or conflicts of interest that could hurt the plan. One exemption is allowing fiduciary investment advisors to provide investment advice to participants who direct investments into their own accounts. So let's talk about bonding as well, because that deals with protection. Anyone handling plan funds or other plan property must be covered by a fidelity bond, which is an insurance policy that covers policyholders for losses that result from fraudulent acts and dishonesty. Before I mentioned a summary plan description, but what else does it include? Other documents that should be disclosed to participants to keep them informed and alerted are a summary of modifications, which are what they sound like, they're changes to the plan, an individual benefit statement. This shows the total plan benefits earned by each participant, vested benefits, and the value of each investment in the account. And there's also a summary annual report, and this is a narrative of the plan's annual return and the plan's report to the federal government. These reports can be given in paper or electronically through email or on the plan's website, only after notifying employees that they will be published electronically. Participants actually have the right to opt out of the electronic disclosures and switch to paper only if they choose. Reporting to our government was a common theme throughout our presentation, but let's get a little bit more specific when dealing with compliance with our government. Depending on the number and type of participants covered in the plan must file one of the following forms. Form 5500, Annual Return of Employee Benefit Plan, which we covered. That same form, S through F, which is a short form. That same form in the version EZ, which is Annual Return of one participant. They might have to file a 1099-R, which are distributions from pensions, annuities, retirement or profit sharing plans, or IRA. They might have to file a Form 8955 SSA, and this is an annual registration statement identifying separated participants with deferred vested benefits. And when filing these forms, there can be mistakes. Those in charge, no matter how long they've been doing it, can still make mistakes. That's okay though. The U.S. Department of Labor and IRS have correction programs to help profit-sharing plans and their sponsors prevent and correct errors. And they protect interests and they keep tax benefits when errors are made. Well, this is the end for Team 8's presentation on a profit-sharing plan. We really believe in this plan. We believe that it works. And hopefully now you do too. Thank you so much for listening.